up, everybody? It's your local curly hair real estate agent. Happy New Year. We finally made it to 2025. I don't know about you, but I think this is going to be a pretty good year. I want to say thank you to all of my subscribers. It was a goal of mine to hit 100 subscribers by the end of 2024, and I literally hit 100 the last day of 2024. So thank you to all of you for making that possible, and thank you for watching and liking my videos. Let me know in the comments below what new content you want to see in the new year. So for today's video, I want to talk about the difference between FHA loan and a conventional loan. I want to break down what the difference is between each one and also go over the advantages and disadvantages of each loan. Starting with FHA loan. FHA stands for Federal Housing Administration, and it is a loan backed by the government. You can qualify for an FHA loan with a credit score as low as 580. If you have a credit score of 580 or higher, you will be required to put a minimum of 3.5% down on a home. So for example, if you were to buy a $300,000 home, you would be required to put 3.5% down, which would be $10,500 as your down payment. Now, there is an exception for the minimum credit score requirement for an FHA loan. That exception is if your credit score is below 580 but above 500, you would be required to put 10% down as your down payment. Now, it is important to note that lenders are allowed to put their own requirements on FHA loans. For example, lender A could require a minimum credit score of 600, where lender B may require a minimum credit score of 650. So it can be harder for you to find a lender that will accept a minimum credit score of 580. So it's important for you to try to get your credit score as high as you can before even talking with a lender. I would recommend trying to get your credit score to at least 620. That way you will become eligible by more lenders to qualify for an FHA loan. But of course, the higher the credit score, the better. Now, with an FHA loan, you want your DTI to be low. DTI stands for debt to income, and I have an entire video explaining what DTI is, why it's important, and how to try to keep it low for when you go to buy a home. Your maximum DTI ratio will vary depending on your lender, but there are exceptions where you could get away with having a maximum DTI as high as 57%. Your lender will work with you to determine what range you should fall in, but remember, the lower your DTI, the less risky you are to lenders, which will ultimately help you get approved for a larger loan amount. So let's talk about the advantages of getting an FHA loan. First of all, they require a lower credit score and they require a lower down payment amount. Higher DTI ratios are more acceptable for an FHA loan as compared to a conventional loan. And finally, dependent on your credit score, FHA loans could offer more competitive or lower interest rates. Now let's talk about the disadvantages of getting an FHA loan. One major disadvantage is mortgage insurance. Yeah, everybody hates insurance, right? If you get an FHA loan, you will be paying mortgage insurance for the entire life of the loan. The only exception is if you were to put as much as 10% down on your down payment for your home, then you would only have to pay mortgage insurance for the first 11 years, and then the mortgage insurance will fall off after that. But if you don't have 10% or more as a down payment to put down on your home, then you will be paying that mortgage insurance. Another disadvantage is that lenders will charge an upfront mortgage insurance premium. This is a one-time fee that is 1.75% of the loan amount. So if you were to buy a $500,000 home, you would be required to pay $5,250 for the upfront mortgage insurance premium. You can roll that payment into the cost of your home, so you're not having to come out of pocket at the closing table, but they will add it into your loan amount. Another disadvantage of getting an FHA loan is that they're made for owner-occupants only. Investors or those trying to get rental properties do not benefit from this type of loan because the FHA loan is made for owners to occupy the home. Now, this does not mean that you can never rent out your home if you were to get an FHA loan. Basically, what it means is that you would have to live in the home for at least 1 year before you're allowed to rent it out. In addition to this, most lenders will require you to move into your home within 60 days of closing. Another disadvantage about an FHA loan is that sellers will typically see an FHA loan as more risky. They find it riskier because of the lenient financing requirements, like the requirement to have a lower credit score and also having a higher DTI. In addition to this, if the home does not appraise under FHA standards, the buyer has a few options on what they could do. One, they could try to renegotiate the price for what the appraisal came back for. Two, they could request the necessary repairs that need to bring it up to standard. Or three, they could walk away from the deal and get all of their earnest money back. All these reasons make it less favorable for sellers to accept FHA loans. So if we are in a seller's market, you might be at a disadvantage if you can only qualify for an FHA loan. If you find this information helpful, go ahead and hit that subscribe button down below and we'll keep it moving. All right, now moving on to conventional loans. A conventional loan is not backed by the government and they're instead backed by private lenders like Fannie Mae and Freddie Mac. The minimum credit score for a conventional loan is 620. But like I mentioned when we talked about FHA loans, different lenders may have different requirements for credit scores. So one lender might require a higher credit score to get approved for a conventional loan as compared to a different lender. As for your DTI ratio, you want to keep it low. The minimum requirement will vary depending on the lender and also your financial circumstances. But if you have a higher cash reserve and a good credit score, you could get a DTI ratio in the high 40s, maybe even low 50s. But again, it all depends on the lender and then also your credit score and the amount of cash you have on hand. Now let's talk about the advantages of a conventional loan. I think one of the biggest advantages is that you do not have to pay private mortgage insurance when you reach 20% equity in your home. If you're able to put 20% down on your home, then you automatically get out of paying private mortgage insurance. And the reason behind this, if you were to foreclose on your property, the lender would believe that they could sell the property and either break even or make a profit off of the sale. So if you don't have enough equity in your home, which would be at least 20%, the lender would still want that sense of security by charging you private mortgage insurance. Now, you might be thinking 20% down as a down payment is a lot, and I agree, that is a lot of money to put down as your down payment. But if you're not able to do a full 20%, that is okay. Unlike FHA loan, where you're required to pay mortgage insurance through the entire life of the loan, a conventional loan will allow you to eventually stop paying mortgage insurance once you reach 20% equity in your home. So if you don't put the initial 20% down, there are other ways that you can eventually eliminate that private mortgage insurance, and you can do that by either reaching 20% equity in your home after making several payments, or your home could go up in value. If you believe your home has gone up in value, you'll want to make sure you reach out to your lender to find out what the process is of canceling PMI based on appreciation. Another advantage of having a conventional loan is that your PMI amount is typically a little bit lower under a conventional loan as compared to your PMI amount that you would pay for an FHA loan. And again, PMI stands for private mortgage insurance. Another advantage to a conventional loan is that it's a very common misconception that you need to have 20% to put down on your home. That isn't true. You can get as little as 3 or 5% down, but you do need to talk to your lender because it will vary depending on the lender, your credit score, how much cash you have. There's a lot of factors that do go into it, but you do not have to have as much as 20% to get approved for a conventional loan. I would recommend talking to your lender and asking them what options are available if you did want to go the conventional loan route. And finally, another advantage is that investment properties are allowed under conventional loans. The down payment requirements are higher because lenders think that rental properties are a lot more risky, but you don't have to wait an entire year before you can rent out the home. Now let's talk about the disadvantages to a conventional loan. For one, you need to have a higher credit score compared to an FHA loan. Depending on your credit score, your interest rate might be higher. Another disadvantage is that you typically want to have a lower DTI for a conventional loan, which can be harder to achieve. Depending on your DTI and credit score, you may be able to qualify for both FHA and conventional, but the amount that you would get approved for a conventional loan might be much lower as compared to the amount that you would get approved for an FHA loan. My recommendation, if you are able to qualify for each type of loan, you should request 2 loan estimates. One loan estimate for an FHA and the other loan estimate for a conventional loan. This will help you be able to compare them and for you to see which one would benefit you most. You really do want to look into what will benefit you for the short term and long term. For example, if you do not have 20% to put down on your home, you will have to pay PMI regardless of which loan you select. And if you don't plan on living in that home for a long period of time and you plan on selling that home before you hit 20% in equity, then the FHA loan may work better for you. But if you plan on living there long term and you think that you'll hit that 20% equity, the conventional loan route might be a better option for you. If you're in a seller's market and sellers are not accepting offers with an FHA loan, you may want to consider getting a conventional loan. But really, this is why I recommend getting 2 different loan estimates. That way you can compare the two and see which option would be most beneficial for you, short-term versus long-term. All right, I know that was a lot of information, so I'll do a quick little recap about the major differences between FHA and conventional loans. FHA loans are backed by the government and they allow you to have a lower credit score, and they typically allow you to have a higher DTI ratio. Your interest rate will also be a little bit lower with having an FHA loan. Conventional loans are not backed by the government, and they are backed by private lenders like Fannie Mae and Freddie Mac. You are not required to put 20% down for a conventional loan. You can speak to your lender and figure out what options are available, but you can put down as little as 3 or 5%, all depending on the lender and your financial circumstances. The major thing with a conventional loan, you can avoid private mortgage insurance once you hit 20% equity in your home. And finally, conventional loans allow investment properties and they do not require you to live in the home for at least 1 year. That's everything I have for you today. I hope you found this video helpful and informational. If you have any questions or maybe different topics that you want me to cover throughout the year, let me know in the comments section below, and don't forget to subscribe so I can see you next time.